Right now, there is money in your bank account. It isn't there, not a single dollar of it. It was lent out, probably this morning, to a stranger you'll never meet, for a house you'll never see. And when you check your balance tonight, the number will still be there, glowing on your screen, as if the money were sitting in a vault with your name on it. It isn't. It never was. This isn't a scandal. Nobody stole anything. This is the business. And if you want to own a bank, it's the first thing you have to understand. Because you are not buying a vault. Here's what you're actually buying. Start with the obvious question. What does a bank cost? The answer is strange, because a bank isn't really something you buy. It's something you're granted permission to be. You don't purchase a bank the way you'd purchase a restaurant. You apply. You go to a regulator. In the United States, that's the OCC for a national charter, or your state banking department, plus the FDIC for deposit insurance, and you ask for a charter, a license, permission to hold other people's money. And they will make you earn it. Before you file a single form, you'll need seed money, the organizer's own cash, and it is not small. Legal fees alone routinely run over $200,000. Consultants for the business plan, another $150,000. Budget at least $500,000 just to ask. Then comes the capital. Not the building, not the marble, not the vault. The capital, the money that stands behind your promises. For a new bank in the United States, that number typically starts around $20 million, and regulators can demand more depending on what you plan to do. They'll require you to hold a Tier 1 capital ratio of at least 8% of your assets for your first 3 years. They'll want a board of at least 5 directors, each one investigated, each one vetted for character and competence. And then you wait. The approval process stretches well past a year, and often much longer. Here's how hard this actually is. Between the year 2000 and 2008, roughly 150 new banks were chartered in America every single year. In 2023, 6 opened. In 2024, 6 again. 6. So the first counterintuitive thing about owning a bank is this. The hardest part isn't the money, it's the permission. And the permission exists for a reason, because of what happens the moment you open your doors. Which means that before you have earned a single dollar, you have already made a promise you cannot keep. Not to everyone, not at once. Hold on to that, we'll come back to it. And it will cost someone everything. Because now the doors open. The first customer walks in and hands you $1,000. Stop. Because here is where your instincts betray you. That $1,000 is not your money. On your balance sheet, that deposit is a liability. It's a debt. You owe it. The customer can walk in tomorrow morning and demand every cent of it back, and you are legally obligated to hand it over. Meanwhile, the loan you make with that money, the mortgage, the business loan, the 30-year note, that is your asset. That is what you own. Read that again, because it inverts everything the word bank suggests. The money coming in is a debt. The money going out is what you own. A bank is not a safe. A bank is a machine that turns other people's money into your assets and promises every single day to give it back the moment they ask. And now that machine is about to do something most people flatly refuse to believe the first time they hear it. It doesn't move money. It makes it.
Here is the part that sounds like a conspiracy theory, except it's in every economics textbook, and the Bank of England published a paper spelling it out. When a bank makes a loan, it does not walk into a vault and take out somebody else's cash. It types a number into an account. That's it. The borrower now has money that did not exist a moment ago. You didn't move money, you created it. Follow it. Your first customer deposits $1,000. You keep a fraction and lend the rest, say $900, to a man buying a truck. He pays the truck dealer. The truck dealer deposits that $900 in his own bank. That bank now has $900 of fresh deposits, and it lends most of that out again. The original $1,000 has not moved. It is still sitting on your books, still owed to your first customer, who still believes he can withdraw every cent of it tomorrow morning. But out in the world, there is now $1,900 where there used to be $1,000. Run that loop enough times, and the money multiplies. This is not a trick. It is not fraud. It is how virtually every dollar in the modern economy comes into existence. Most of the money in circulation was never printed by a government. It was typed into existence by commercial banks as loans. Now, a caveat, because this is where cheap explanations go wrong, and the people who actually work in banking will close this video if I get lazy here. The limit on how much money you can create is not some magic pile of reserves in the basement. In practice, your limits are three things: capital, regulation, and appetite. Capital, because every loan has to have a slice of your own money standing behind it. Regulation, because supervisors set the ratios, and they can shut you down. And appetite, because every loan you write is a bet that a stranger will pay you back. So, you are not a vault. You are a factory. And the product you manufacture is money. Which brings us to the question you've been waiting for. How does this factory make a profit? Ask most people, and they'll tell you the same thing. Banks borrow cheap and lend expensive. They pay you almost nothing on your savings account and charge you a fortune on your mortgage, and the gap in the middle is the profit. That gap has a name, the net interest margin. And yes, it is real. And yes, it is the core of the business. But if you think that's where the money is, you are only seeing half the bank. Here is the number that surprises people. Across the past decade, roughly 35% of the total income of American banks did not come from interest at all. In one recent year, that figure came to about $295 billion. $295 billion from things that are not loans. So, what is it? Fees. All of it. Fees. Monthly account maintenance, overdraft charges, wire transfer fees, ATM fees, card interchange, the invisible cut the bank takes every single time you tap your card at a coffee shop, foreign exchange spreads, wealth management fees, a fee for depositing a check the wrong way, a fee for closing your account too early, a fee for keeping too little money in the account you opened because you had too little money. And fee income has a quality that interest income does not. Interest income depends on a stranger paying you back. Fee income doesn't. Interest income collapses when central banks cut rates. Fee income doesn't. When a borrower defaults, you lose the loan. When a customer overdrafts, you gain a fee.
The loan is the product. The fee is the profit. So now the picture is complete, and it is a beautiful business. You take money that isn't yours. You lend it out at a spread. You manufacture new money in the process.
And then you charge the customer for the privilege of participating in the machine that is using his money. There is only one problem. Look carefully at what you've built. Everything you owe, every single deposit, is payable right now, today, on demand. And everything you own, the mortgages, the business loans, the 30-year notes, the long-dated bonds, is payable slowly, over years, sometimes decades. Your debts are instant. Your assets are frozen. This gap has a name. Bankers call it maturity transformation, a very calm phrase for a very strange act. Borrowing short to lend long. It is not a defect in the machine. It is the machine. It is the entire reason a bank earns anything at all. But it means something that should keep you awake at night. A bank can be perfectly profitable and completely dead in the same week. Because profit is an opinion about the future, and liquidity is a fact about today. None of this is broken. It works. It works beautifully. For as long as the depositors believe the money is there. But before we watch that belief break, you have to survive running the thing. Because there is a cost to owning a bank that has almost nothing to do with money. And it will decide whether you live long enough to ever face a panic at all. Here's the thing nobody tells you about owning a bank. You are not a businessman anymore. You are a deputy. The moment you accept that charter, the government hands you a second job you did not ask for and cannot refuse. You become an unpaid enforcement officer of the United States government. Your job is to watch your own customers, to know who they are, to know where their money came from, and to report them when something smells wrong. That is not a metaphor. It is the law, and it is, quietly, the most expensive part of running a bank. Because compliance is not a department in the corner of the building. It is a tax on every hour of every employee's day. Every account opened has to be verified. Every large cash deposit has to be reported. Every transaction has to be screened against sanctions lists, watch lists, patterns of suspicion. And every one of those checks costs money, whether the customer is a drug trafficker or a grandmother depositing a birthday check. The numbers here are brutal, and they explain almost everything about the shape of American banking. For a community bank, compliance consumes something on the order of 8% of all non-interest expenses. But look closer, and the real story appears. The smallest banks spend roughly 11 to 15.5% of their entire payroll on compliance work. At the largest banks, that number is 6 to 10%. Read that again. The small bank spends double the share of its payroll on paperwork. Why? Because regulatory cost behaves like a fixed overhead, not a variable one. Whether you have 10,000 customers or 10 million, you still need the software, the compliance officers, the audits, the reports. The rules do not scale down gracefully, which means the compliance burden is, in practice, a machine for killing small banks. That is not its intention, but it is its effect. And it's a large part of why America chartered around 150 new banks a year in the early 2000s, and 6 in a recent year. Now, if you think all this is bureaucratic theater, let me show you what happens to a bank that treats it that way. In October of 2024, TD Bank, the 10th largest bank in the United States, stood in a federal courtroom in New Jersey and pleaded guilty to a crime. Not a civil violation, a crime. Conspiracy to commit money laundering and failure to maintain an anti-money laundering program. Here is what they had done. Over roughly 6 years, TD Bank failed to monitor about 92% of its transaction volume. That is not a rounding error. That is approximately $18.3 trillion of customer activity flowing through the bank unwatched. And the criminals noticed. 3 money laundering networks pushed more than $670 million of illicit money through TD Bank accounts. One launderer walked into branches in Queens, New York, carrying bags of cash, more than $470 million in total, and the tellers processed it. Because he paid them. He bribed bank employees with more than $57,000 in gift cards. And inside the bank, the employees had a joke about it. TD Bank's advertising slogan was, "America's most convenient bank." They used that line to describe how convenient the bank had become. For criminals.
The Attorney General of the United States put it in one sentence. By making its services convenient for criminals, the bank became one. The bill came to over $3 billion in penalties, the largest fine in the history of the law it broke. But here is the part that should genuinely frighten anyone who owns a bank. The fine was not the worst thing that happened to them. Regulators capped the bank's growth. They put a hard ceiling on how large its American business is allowed to become, and not $1 more. They installed an independent monitor inside the company to sit there and watch it for years. Understand what that means. The regulators didn't just take money, they took the future. Because your charter is not a trophy on the wall. Your charter is the asset. It is the only thing separating your marble lobby from a very expensive building full of nothing. And the people who granted it to you can restrict it, shrink it, or, in the most extreme case, take it back entirely. So this is the true operating cost of owning a bank. It isn't the branches. It isn't the tellers. It isn't the vault. It is the permanent, exhausting, unglamorous work of proving every single day, forever, that you still deserve to be trusted with other people's money. And here is the tragedy. You can do all of it perfectly. You can pass every examination. You can file every report. You can monitor every account and screen every transaction, and never take a bribe and never cut a corner. You can be, by every single measure a regulator uses, an excellent, careful, profitable bank, and still lose everything in about 44 hours. Let me show you how. In March of 2023, there was a bank in California called Silicon Valley Bank. It was not a scam. It was not obviously badly run. It was the 16th largest bank in the United States. It held over $200 billion in assets. It had served the technology industry for 40 years, and it was profitable. On a Wednesday, it was a healthy bank. By Friday morning, it did not exist. Here's how the machine ate itself. During the pandemic, money poured into technology startups, and those startups put their money in Silicon Valley Bank. Deposits exploded from around $62 billion in early 2020 to over $120 billion just a year later. That is a beautiful problem to have. But remember what a deposit is. Every one of those dollars was a liability, money the bank owed, payable on demand. So the bank did what banks do. It went looking for assets, and it bought bonds, long-dated government bonds. Safe, boring,
backed by the United States Treasury. By the end of 2022, it was holding a bond portfolio of about $117 billion. Nothing about those bonds was fraudulent. They would pay out in full, exactly as promised. Eventually. Then, the Federal Reserve began raising interest rates at the fastest pace in decades. And here is the cruel arithmetic of a bond. When new bonds start paying higher interest, the old, low-interest bonds sitting in your vault become less attractive. Nobody wants to buy your bond paying 2% when they can buy a fresh one paying 5%. So the market value of what you're holding falls. On paper, you are sitting on an enormous loss, and that loss is completely invisible as long as you never have to sell. But the depositors were pulling money out. Startup funding had dried up. The tech layoffs had begun. Companies were burning through cash just to stay alive, and the bank needed real money to pay them. So, on the 8th of March, Silicon Valley Bank sold a chunk of its securities to raise cash and booked a loss of $1.8 billion. Then, it announced it would raise more than $2 billion in fresh capital to fill the hole. That announcement was designed to reassure everyone. It did the opposite. Because what the depositors heard was not, "We are solving a problem." What they heard was, "The bank needs money." Now, imagine you are one of them. You're a founder. You run a company with 60 employees. Every dollar your business has, payroll, rent, the money you owe your suppliers, the runway that keeps the lights on, is sitting in an account at Silicon Valley Bank. Not because you were careless, because that is where everyone banks. Your investors banked there. Your lawyer told you to bank there. It was the safe, obvious, grown-up choice. And on the night of the 8th of March, your phone starts buzzing. It's a group chat. Someone forwards a screenshot. Someone else says they're wiring their money out tonight, right now, just in case. A venture capitalist you have never met posts a warning to 100,000 strangers. Your investor calls you and says one sentence: "Get your money out." And here is the trap the 21st century built. You do not want to cause a bank run. You know, everyone in that chat knows, that if all of you pull your money at once, the bank dies, and it dies because you killed it. You know the bank is probably fine. You know the panic is the real danger. But you also know something else. If the run happens anyway, and you are the last one out, you get nothing. The FDIC insures deposits up to $250,000. Your payroll account has millions in it. If you wait and you're wrong, you cannot pay 60 people on Friday. So you do the rational thing. You open the app and you click transfer. And so does everybody else. The classic bank run is a photograph from the 1930s. A line of people in overcoats stretching around the block, waiting for the doors to open in the morning. It took days. And those days were a gift. Time for the bank to raise cash, time for regulators to step in, time for people to calm down and think. This one did not take days. Nobody had to walk anywhere. Nobody had to stand in a line. Nobody had to wait for the doors to open. Because the doors are in your pocket now, and they never close. By the end of the following day, customers had tried to withdraw $42 billion in a single day, roughly a quarter of the entire bank. There was no vault deep enough. There never is. The money wasn't there because the money is never there. It was out in the world, lent long and locked up, exactly as the model requires.
The next morning, regulators seized the bank. The employees had received their annual bonuses just hours earlier. From healthy to gone in about 44 hours. Now, the part that matters more than the story. Silicon Valley Bank did not die because it was uniquely reckless. It made real mistakes. It was dangerously concentrated in one single industry where every customer knew every other customer and they all talked. And extraordinarily,
It went months without a chief risk officer during the exact period interest rates were climbing. Those failures were real. They made it fragile. But the killing blow was not exotic. It was the model. The same model every bank on earth runs on. Understand this clearly because it is the entire point of everything you have just watched. No bank, not one, not the biggest, not the safest, not the one holding your paycheck right now, can survive all of its depositors asking for their money at the same time. That is not a flaw in a badly run bank. That is the definition of a bank. Which is why the whole system leans on two crutches, and both of them are made of belief. The first is deposit insurance. The FDIC guarantees ordinary deposits up to $250,000, which means most people have no reason to run, and a bank run that nobody joins is just a quiet afternoon. The second is a central bank willing to act as the lender of last resort, to hand a solvent bank the cash it cannot conjure fast enough on its own. Neither of those things is a vault. They are promises about promises. Banking doesn't run on money. It runs on the belief that the money is there. So, should you own one? In a good year, the answer is a resounding yes, and it is obvious why. You hold other people's money and pay them almost nothing for it. You lend it out at a spread and keep the difference. You collect a fee on every card swipe, every transfer, every overdraft, every account. And you do all of it on leverage, which means the return on your own capital can be extraordinary. There is a reason banking is one of the oldest, continuously profitable businesses in human history. Done well, it is a machine that quietly compounds for 100 years. And in a bad year? You don't get a bad year. That is the point. A restaurant with a bad year loses money. A factory with a bad year cuts a shift. A bank with a bad year can simply cease to exist between a Wednesday and a Friday because the loss does not arrive through your income statement. It arrives through the door, as people, all at once, asking for exactly what you promised them. In most businesses, you lose slowly. In banking, you lose all at once. So here is what you were actually buying all along. Not a vault, not the marble, not the columns, not the great steel door with the brass wheel on the front. That was set dressing. It was always set dressing, built to look reassuring precisely because the thing it is reassuring you about isn't true. You were buying a promise you can keep for almost everyone, on almost every day, for almost forever. And a promise is only worth as much as the number of people who believe it, on the morning they all decide to check. That's the economics of ownership.